All right, for this video, I wanted to talk with you about U.S. tax issues for B-1 visa holders. Okay, so what's a B-1 visa? B-1 visas are issued to non-U.S. persons that want to enter the U.S. for business reasons, right? So for some type of temporary work assignment. While the B-2 visa is for tourism. Now you notice that a lot of times you're applying for these simultaneously, right? So you get a B-1, B-2 visa. So it allows you to enter for tourism and then also kind of just temporarily be in the U.S. If you work for a company that wants to send you to the U.S. for a conference or to an affiliated office, you can work there. There's generally no issue. So who gets a B-1 visa for work purposes? Well, some of the big categories here are athletes, right? So if they want to travel to the U.S. to compete, and they're competing for money, business visitors, just broadly speaking, or domestic employees or nannies that are accompanying foreign national employers. So, what are the tax issues for B-1 visa holders? Well, the first thing to consider is that simply having a B-1 visa does not make you a U.S. tax resident. And U.S. tax resident is significant because when you become a U.S. tax resident, you're subject to tax on all your income from no matter where it comes from. Which is not something you want to do if you are not a U.S. Citizen or green card holder, right? You want to avoid that generally, particularly if you're only in the U.S. for a few weeks a year. So, so the B-1 visa holder, you're not automatically a U.S. tax resident, but you might still be subject to taxes, right? And this is because whenever you come to the United States to work and earn money while you're physically in the U.S., that becomes U.S. source income, right? So income under the tax code is sourced to where you're generally performing the work. So if you come to the U.S. for 3 weeks and you're working in the United States, even if you're being paid from a foreign employer, it's still going to be U.S. source income, right? And so you might still have to file a return and pay taxes. So very, very important, right? So the other consideration is that B-1 visa holder, if you are in the U.S. too many days during the year, then you could become a U.S. tax resident, right? And this is that substantial presence test. So most B-1 visa holders and B-2 visa holders get a 6-month visa. So you can be in the United States physically up to 6 months per year. Well, if you go up to that threshold more than 1 year in a row, you could potentially become a U.S. tax resident, right? So the substantial presence test is a 183-day per year count, but if you look at the way it's calculated, it counts all the days in the current period plus a portion of the days from the prior 2 years. So for example, if you're in the United States for 180 days, year one, you didn't meet the substantial presence test, okay. But then in year two, if you come back for another 180 days, you will meet the substantial presence test for year two because they're going to count all the days in year two, 180, plus a percentage of the ones from the prior year. Now you exceeded the 183-day count. So very, very important that if you are in the U.S. on a temporary visa, so B-1, B-2, always make sure to track your days so you don't trip over that line. Now, where's some treaty relief come into play here? So in this example I've got here with the UK, B-1 visa holders, if you are a resident of the UK and you're coming to the US as an athlete or an entertainer, Article 16 of that treaty provides that you can exempt up to $20,000 of income. Now, the reason why that's significant in the US is because there's really no threshold for US source income and having to file a 1040-NR. So anytime that you're physically in the U.S. and you're earning income, so compensation, you're considered engaged in U.S. trade or business. And so even if you earn, let's say, $1,000 while you're physically in the U.S., you technically still have to file a 1040-NR and pay taxes on that income. Because remember, if you're a non-resident filing a 1040-NR, you don't get a standard deduction. There are exceptions for residents who are from India. India has a unique carve-out where you can get a standard deduction, so that could wipe out all your income. You are allowed to itemize deductions, but again, you have to file to claim them. So the treaty relief is very, very helpful, right? 20K exemption, but you have to file a 1040-NR file the 8833 to claim the treaty benefits. Okay. Now, the last item I have there, the closer connection exemption. What is that? Okay, so if you are physically in the United States under a B-1 or B-2, and you're in the United States enough days to trip over that substantial presence test, right? Which means that you're now a U.S. tax resident, something that should be avoided, right? Unless you really want to move to the U.S. on a full-time basis. So if you trip over that substantial presence test, so the example I highlighted earlier, year 1, 180 days, not a problem. Year 2, you come back for another 180 days, now you have a problem. Now, because you meet the substantial presence test for year 2, you are a U.S. tax resident for year 2. Okay? Now, because you exceeded the number of days, you can file this 8840, the closer connection exemption, to override that substantial presence test trigger. So the closer connection exemption basically says, look, yes, I was in the United States too many days in year 2, so I met the substantial presence test, but I'm a permanent resident of, let's say France or Germany or wherever, name any country, and given the facts and circumstances, I have a closer connection to this country rather than the United States. And so for that reason, I'm not going to be a U.S. tax resident. I'm going to file this 8840, and that's the end of it. You can file that separately. You don't have to file it with a 1040 NR. You can if you want. In most cases, you're probably not going to do that because in order to file 1040 NRs, you need an ITIN. And a lot of individuals aren't going to go down that path and get one unless you already had one, if those circumstances permit it. But most of the time, yeah, if you find that you accidentally tripped over that substantial presence test rule, then you can file this 8840, and that'll override the U.S. tax residency for you and provide you some relief. And believe me, that is well worth doing because, again, think of the impact here. If you become a U.S. tax resident, not only are you filing a 1040 resident return, right? So a IRS Form 1040, regular individual income tax return, you're reporting all of your income from every source derived, right? So foreign, U.S., investment income. If you have foreign bank accounts, now you need to do FBARs. So you got FinCEN 114s to file. If you've got substantial assets overseas, you might be doing 8938s for foreign financial assets. You might have PFIC disclosures, controlled foreign corp disclosures. Maybe you're a beneficiary in a foreign trust. Now you got 3520s. The list of forms that you need to file and the taxes that you have to pay once you become a U.S. tax resident can be egregious. And so for those reasons, you want to make sure that, okay, if I'm in the U.S. enough days to maybe accidentally trip over this line, go ahead and get this 8840 filed and try to, argue that you have a closer connection with another country so you don't become a U.S. tax resident. Okay, so I hope that was helpful. If you have any questions, obviously leave me a comment below, and I try to answer as many as I can. And so yeah, that covers it. Thanks for watching, and I look forward to seeing you again on the next video. Take care.